Hi, my name's Anthony Schifano, and this is episode 2 of Let's Talk Debt. During this episode, we're going to be talking about the definition of the term interest and what it means for us in the context of debt. So without further ado, we're going to go over to Investopedia, and this article on interest and its definition was prepared by James Chen, so all credit goes to him and Investopedia. Last updated November 25th, 2020, so if there's any changes on this in the future, if you're watching this down the road, there could be some changes on there from what I'm talking about today. So, what is interest? They state that interest is a monetary charge for the privilege of borrowing money. If there's nothing other than that you get for the definition of interest, in a nutshell, that's all you need to remember. It's the monetary charge, so the amount in whatever your currency is. For our purposes here, we're going to talk about dollars. So the charge in dollars for the privilege of borrowing money. And then they have typically expressed as an annual percentage rate. That's something we'll be talking about a bit later. And the difference between annual percentage rate and interest rate. And it has there, interest is the amount of money a lender or financial institution receives for lending out money. Interest can also refer to the amount of ownership a stockholder has in a company, usually expressed as a percentage. So for our purposes here, we're going to be focused on the debt side. So they're also stating interest as like your financial interest in a company, but for us, we're just going to be focusing on debt. So the first thing we're going to break down, difference between annual percentage rate and interest. The difference there is interest is just the fee that the lender is charging you as a percentage. Usually when you see a statement from a lender, when they're giving you a quote on a loan, it'll show you what the interest rate is first, and then it'll show you the annual percentage rate separately. And usually the annual percentage rate is higher than the interest rate. Reason being, when you click on that link there, you can click on annual percentage rate, and it'll take you to the link through Investopedia where it defines annual percentage rate and shows you the equations of how to calculate it. The biggest difference is just annual percentage rate includes all the other fees that the lender is going to charge you above and beyond the interest rate. So when you're looking at a loan and you're comparing one loan to another, you really need to compare the APRs because that includes all the fees. That's your bottom line number when you're looking at how much this loan is going to cost you in real terms. And I'm going to draw you a quick example of what that looks like when you're looking at specific loans. So I'm going to use the example of a mortgage. And you can rest assured that we'll be talking about mortgages in more detail later. Mortgage, just a quick fun fact. If you look at the origin of the word, mort, meaning death or dead, gage meaning pledge, so it's a death pledge, which is a funny little fact out there. With the origin behind that being mortgages are very, very long loans, so it's kind of like I'm paying this off until I die, more or less, is kind of the joke. Okay, so on a mortgage, let's just say you have an APR of 4%. Your interest rate is 3%. So again, these aren't the rates of today, but that just kind of shows you this is pretty common to what you'll see is your APR there is a little higher because it includes a lot of other miscellaneous fees, that kind of stuff there, a lot of other stuff. Interest rate is just the base rate that they're charging you. So it's always really important when you're looking at debt. You want to know with any kind of transaction, what's my bottom line? I don't care about the stuff up here. I care about what are all the other things that you're adding to this to get to that APR. Alrighty. So continuing on that article on interest rates, I'm going to jump back here. Okay. So I'm going to go over the other points on here as far as the definition of an interest rate goes. Again, we're excluding anything talking about ownership and stocks. Key takeaways: interest is a monetary charge for borrowing money. That's true. Generally expressed in percentage terms, such as an annual percentage rate. That's one of the types of percentage rates that they will show you. Okay, so now here's some more meat and potato stuff. Key factors affecting interest rates include, and I'm just going to break these down one by one as we go so we don't get confused here, the inflation rate. So if you've heard of the term inflation before, the general idea behind inflation is that it is the amount every year that our money decreases in value. So if you've heard of people talking about inflation, a lot of times they talk about, well, back when I was a kid, ice cream cone only cost 25 cents or $1, something like that. Each year, the cost of goods gets a little bit higher and higher and higher, usually by a few percent a year. I know for a long time it's been hovering around about 2% a year. So the way to look at that is the cost of goods has gone up about 2% a year, or the purchasing power of my money has gone down about 2% a year. Both of those are saying the same thing. So what does inflation have to do with the amount of interest that you're going to be charged? It's pretty simple. I'll draw you a little demonstration here. So what you have to remember is when a financial institution is lending you money, they are taking on risk. They're taking on the risk that you don't pay them back. But one of the biggest risks that they're taking on when they're lending to you is that the amount of dollars that you're paying back to them, so the monetary charge, that interest that you're paying back to them little by little, is going to be worth less over time. That is one of the reasons that a lot of long-term debt, if you look at the long-term effect of owning it for certain financial assets like owning a home, can be pretty sweet in the long term, because with mortgages, your payment, unless you refinance, is going to stay the same over time. So when you start your mortgage, let's say you're paying $1,000 a month in your mortgage. If it's a 30-year mortgage, 25 years from now, you're still going to be paying $1,000 a month. But it's going to be a lot easier for you to pay, because 25 years from now, that $1,000 a month in real terms is going to be worth a lot less than it is now. So in that way, each year that you're paying that mortgage, that payment is becoming less and less and less and less. And when banks are calculating what interest rate to charge you for the privilege of borrowing that money, their outlook on inflation is something they really have to take into. Otherwise, they could well lose money in real terms during the course of the loan. And we've had periods like this in U.S. history. So back in the 70s, when we really had runaway inflation, banks more or less were just taking it on the chin. And you saw for the loans that they had issued previously, before interest rates spiked, before inflation rates spiked. So we had really high inflation. And where inflation goes, interest rates go also. So I'll just draw that here as an example. So inflation, and this is important to remember. Inflation and interest rates, they go up together, and they also go down together. So during the 70s, when we had really high inflation, when the cost of goods and services was going up very, very rapidly, the value of the dollar was going down pretty rapidly at the same time, which meant that for banks to even hope of getting their money back on these future loans, they had to charge really high interest rates. I mean, we saw interest rates during that historical period that were getting close to 20% to buy a home, which is crazy when you think of today, when like you can get a 30-year fixed rate mortgage in the 2s or low 3% range. That shows you the direct relationship between inflation and the interest rate. So built into your interest rate is inflation. And again, for all the loans that banks were writing before that like heavy inflationary period started, banks lost a lot of money because you're paying, let's just say 7% interest on your home, on your mortgage, but then inflation went to 17% a year, which meant that every single year, with that example that those conditions existed, the bank was eating 10% on that mortgage. Pretty crazy to think about, because what the bank holds as far as debt goes is an IOU from you. And the thing to remember is, because that IOU is denominated in dollars, if it's holding a piece of paper that says you owe them 100 grand, but in 10 years that 100 grand is only worth half of what it was, then you make out very well on your part, because you paid them back. You borrowed dollars that were worth a lot, and you paid them back with dollars later that were worth less. So in a nutshell, that's the risk that financial institutions take when they lend you money, is they're giving you money that is worth a lot more than the potential money that you could be paying them back if we have a lot of inflation. And that is why when you do see high interest rates, it's most likely because we have high inflation. Okay, length of time the money is borrowed. So again, this ties into inflation and into the interest rate. So over a long period of time, there's a much greater chance that you will have periods of high inflation or significant inflation. Granted, that has not been the case for a very long time. I'm of the opinion as well that we're probably not going to see large inflation numbers going into the future, just because it hasn't. Since the 70s are more like an anomaly, and we base a lot of our economic thinking on them, on those specific years of the high inflation of the 70s. We haven't had high inflation rates for a long period of time, and I wouldn't expect for us to get crazy high inflation rates in the future. But the reason the length of time is important is that over a long period of time, it's much more likely that we hit one of those periods eventually. So if a bank's lending you money for 5 years, they have a much lower chance that we're going to hit one of those high inflation periods. If they're lending you money for 30 years, there's a lot more risk on their end that we could get high inflation during that period of time. I'm going to cover the last 2 points here then that affect interest rates. Liquidity. So liquidity is the amount of, it could be the liquidity that you have or the liquidity that they have. So liquidity as a term is just the amount of money that's available that you can tap into. So in the marketplace, as far as banks go, liquidity is the amount of money that they have that they can afford to lend. So if there's a lot of money available, think basic supply and demand. If there's a ton of money just sloshing around out there, they're going to be willing to lend it at lower interest rates, because the amount of borrowers isn't as big as the amount of money out there trying to be lent out. And vice versa, liquidity can also mean the liquidity that we have as individuals, the amount of liquid cash we can get to. So likewise, if you're an individual and you have a lot of money, you're probably going to accept a lower interest rate than someone that doesn't have a lot of money, because you can afford to lose. Likewise with banks, if they don't have a lot of cash available, lending is going to be a lot tighter on their end, because if they get some losses from people that don't pay back those loans, they could be in trouble. And that also goes into that last point that you can see there, risk of default. So risk of default is just basically the risk of them not getting their money back, the risk of you not paying them back. So when they're figuring out that interest rate, they have to do a lot of math. They have to figure out, all right, what are we projecting inflation to be? How long are we willing to risk that money being out there before we get it all paid back? Do we have enough money to withstand that risk? Are we liquid enough? Do we have enough cash on hand to withstand changes in the marketplace? And what is the risk that the people we're lending this money to don't actually pay us back? And can we withstand that? So all of those factors, and there are some additional factors that I'll get to in one of the more advanced videos. But in a nutshell, those are the basic ones. Inflation, so think high inflation, high interest rates. Length of time the money's borrowed, the longer you borrow, the higher the interest rate they're going to want. Liquidity, if liquidity is high in the marketplace, interest rates will be lower. If liquidity is tighter on the part of financial institutions or any lender, if liquidity is lower, your interest rate is going to be much higher. And if the risk of default is high on you as the individual, if there's a really high chance you're not going to pay them back, they're going to charge you a much higher interest rate. And you'll be pretty clearly shown that when I go on and specifically define and go over specific investment products, or not investment products, specific debt instruments, such as credit cards, mortgages, car loans, and things like that. You can see like how the interest rates differ and how they differ by your credit score, which more or less is financial institutions giving you a number that more or less lets them figure out how much of a risk you have of defaulting on your loan. Okay, and again, we're skipping that last one. Interest can also be expressed as ownership in a company. Okay, if you scroll down, we're going to get to that at a later video as far as simple and compound interest, because feel free to read through the rest of this article. It has some really good information there, but a lot of the topics we're going to dive a little bit deeper into. So that being said, we'll do a quick recap here. Interest is the amount of money that you're being charged by a financial institution for the right to borrow. Typically expressed as APR because that's the bottom line number. That's the actual interest rate that you're going to pay on the money that's borrowed. Interest is the amount of money that a lender or financial institution receives for lending out money. They collect interest, they collect other fees. Those all get mushed together, and that's how we figure out APR, annual percentage rate. Key takeaways: interest is money charged for borrowing money. So we're taking money, getting it in the present, and the cost of that is that we're paying out more money in the future. Generally expressed as a percentage, such as APR. Key factors affecting interest rates, and this is the big takeaway when you're thinking about interest rates and how do these financial companies figure out what interest rate they're going to charge me and what interest rate they're going to offer to customers in the marketplace. So to figure out interest, they look at, and I'll just write them down here quick as a reminder, they look at inflation, they look at the length of time they're going to be borrowing. The simple term for that is term, so the term of the loan. Liquidity. Liquidity is how much cash they have available. You'll hear terms like, is a bank well capitalized? Is this institution well capitalized? That's all about liquidity. Do they have enough dollars on hand where they can comfortably make loans? And last but not least, risk of default. Do you, as the borrower, have a high risk or a low risk of not paying them back? And again, these aren't all weighted equally. It's very specific by each financial institution for how they calculate the interest rate they're going to charge you and charge to the marketplace. The way that is easy to think about it is that it's an average. So they're taking their projected inflation rate over the term of the loan. So if you're borrowing for 30 years, they're taking the inflation projections for 30 years out. They're looking at the specific terms that they offer. So with homes, a lot of them are 30 years and 15-year loans. In the commercial world, you get to 10-year loans sometimes. Liquidity, they look at the amount that they have to lend out. As far as the term liquidity goes, that they also sometimes look at your personal liquidity. So how much cash do you have on hand? Do you have enough savings? Do you have enough income? Do you have enough spendable monies that you get access quickly to cover this loan should anything go wrong? Likewise, when you're looking at the people that are lending, they need to look at whether or not they have enough money to actually lend out and survive different shocks and risks in the market. And what is your risk of defaulting? Are you going to actually pay them back? So, again, if I've gone over too much, I apologize. But those are the four that go into what your actual interest rate is. If you have any questions, feel free to put those in the comments. As always, be sure to subscribe, and if you have any suggestions for future videos, please let me know. Thank you.